Hello everyone, my name is Anjani Kumar Khetan. I'm based out of Bangalore, and in continuation of the previous video, in part 2, we will conclude our deliberation on the BEPS Action Plan 4, and in this video, we will look at the practical case studies so that we have a better understanding of how the recommendation of BEPS Action Plan 4 can actually be operationalized in a specific fact pattern. So just a quick recap from the last video. We have already seen this, that as part of the 2015 recommendation by the BEPS, we have had three types of core rules, which is fixed ratio rule, wherein the deduction of interest was linked to, the net interest was linked to EBITDA of the individual entity in a country in the range of 10 to 30%. Whereas in the group ratio rule, the ratio is of the entire group rather than individual entity. And of course, targeted rules, we saw that those are intended to ensure that the anti-avoidance measure, so that the situation is not manipulated by artificially either inflating EBITDA or by creating complex organizational groups. So that is something which we have already seen. Now, primary focus of our discussion today would be to look at various case studies to explain these kind of rules. How do you operationalize? How the fixed ratio rule will work? How group ratio rule will work? And how there is an interplay between the fixed ratio rule and group ratio rule. So we will see three different case studies today to consolidate our deliberation on the in the previous video. So let us first look at the illustrative case study on fixed ratio rule. So let's see a scenario. What happens in this case? Consider a scenario wherein City Corp, this guy, is a resident of country A, and this S1 Limited, which is a subsidiary of City Corp, is a tax resident of country B. Now, as part of the global arrangement, City Corp, this group, the holding company, that borrowed funds from the subsidiary company amounting to 50 crore rupees at an interest rate of 12% per annum. So therefore, loan of 50 crores has been given by S1 to City Corp at the rate of 12%. Now, if you look at the financial records for the year 2016-17, which is the year for which we are assessing this, let us say City Corp, this group, had given you these financial information. That for 16-17, the turnover of this entity was 100 crore rupees and EBITDA was 10 crore rupees. Applicable tax rate is 30%. What is most important is this point. Now, country A, where the interest expense gets recorded, country A has adopted the fixed ratio rule. Now, we have seen in fixed ratio rule, the country has the ability to determine that generally within the corridor of 10 to 30%, what should be the permissible limit of the interest to EBITDA. Now, this is what is given here. So here in country A has adopted the fixed ratio rule of 30% of the EBITDA as the maximum interest deduction on the loan. Therefore, in country A, though you have incurred this much of the expense, so your interest expense will be on 12% of 50 crores. But considering that your EBITDA is 10 crores, that interest deduction will be linked to this EBITDA. Let us see the calculation on the right hand side. So in this case, what is the actual interest obligation? Contractually, you have agreed to pay 12% of 50 crores. So your obligation of interest, which is payable to S1, which is your subsidiary company, is 6 crore. And then interest deduction will be restricted. Restricted to what? 30% of EBITDA of 10 crore. So 30% of 10 crore is 3 crore. So because of the application of the fixed ratio rule, which restricts the maximum the tax deduction of the interest to the extent of 30% of the EBITDA. Therefore, even if you are paying or incurring a cost of 6 crore, the tax will be admissible only to the extent of 3 crores. Therefore, if you apply this fixed ratio rule, only 3 crore will be allowed as interest deduction to City Corp by following this fixed ratio rule in country A. Now, $1 million question would be, what happens to the other? So you have incurred 6 minus 6 crore, but your deduction is only 3 crore. So you still have 6 minus 3, balance 3 crores is still left, which is disallowed. Now, what happens to that balance amount? Now, the answer to this question is it depends. Depends upon what is the domestic law, tax law in country A. Whether the domestic law in country A, whether it permits carry forward. If you remember, in the previous video, we talked about that the 2015 version of the action plan 4 report of the OECD, it has given guidance and permitted carry forward subject to meeting certain conditions. Carry forward of disallowed interest. Same principle will come into play here. So to this 3 crore rupees which is disallowed, can it be carried forward subsequently and be allowed in future period? It depends upon how the tax law has been legislated in country A, which restricts the interest deduction. That's how you have to look at it. But let us say if carry forward is not allowed as per the tax laws, then this is a permanent disallowance in the hands of City Corp. Now, it is important to note that in this case, yes, 3 crore there is a disallowance. OECD also recognized that some groups can be highly leveraged with the third-party debt for genuine business reason, not for tax purposes, genuine business reason. And therefore, to supplement this fixed ratio rule, we have seen even in the last video as well, that they said, okay, supplement this fixed ratio rule with what is called group ratio rule. And in this group ratio rule, as we have discussed, the deduction will be on the basis of the same ratio based on EBITDA, but the ratio which is applicable for the entire group, not the specific legal entity. Now, also it is important to note that in some tax jurisdiction, what is called a uplift is also given. So, for example, if say the group ratio is 30%. Now, in some countries, when they apply these group ratio and fixed ratio, they may give something what is called an uplift of up to 10%. That means, in my example, if 30% is your group group ratio, then 10% of this is 3%. Now, if this uplift is also given, then in place of 30%, the group ratio will be reckoned as 33%. That means 110%, including the uplift of 10%, would be 110% of the 30% ratio, which is 33%. This is also permitted in certain countries. When we go to case study number 3, I will explain this concept by way of numerical example, how this uplift also works. Okay. Now, one more important thing, why this uplift is given. Now, this uplift is given to possibly avoid double taxation. Why so? Let us see this. Now, if you look at in this example, what we have 6 crore is your interest expense. But what has been allowed to use only 3 crores. Therefore, you are taxed on 3 crores rupees here. Right? Now, this 6 crore will come to S1 here. Right? So, why the uplift is given? Because you are paying full taxes here, but your deduction is only 3 crore. So, therefore, to partially compensate this, there is a double taxation here. Because, it is not both the sides equal. At the one end, you are incurring expense, and on the other end, the same expense becomes income from a group perspective at some other jurisdiction. Now, this jurisdiction levy full tax on this, but this jurisdiction doesn't give you the deduction for the interest expense. And therefore, this uplift is also intended to avoid what is called double taxation. That's the reason why this uplift is also sometimes given by few countries. I'll explain this concept of the uplift when we go to case study number 3. Right? So this is case study 1. Now let us see how the group ratio rule works. Now here, similar example, you consider a scenario where Citicorp is again a resident of country A and S1, which is a subsidiary, is a resident of country B. They are part of a bigger group called AB Group. So AB Group is the ultimate parent entity, and these two entities are part of that group, and as per the structuring, this S1 is also a subsidiary of Citicorp, and this Citicorp eventually rolls up to the AB Group, which is the ultimate, the at the top of the pyramid. Now, same thing, that Citicorp borrowed same 50 crores at 12% interest. Similar facts are given, but now we have to give more details related to the group also, because we are now applying the group ratio rule. So let us see what are the financial information in this case study has been given to you. It says for FY 16-17, the following details are made available. Now this Citicorp has the similar details. 50 crores of loan, turnover of 100 crores, EBITDA of 10 crore. This is exactly what we saw in the previous case study also. Now, this is new. What about AB Group? Now, AB Group as a whole had a third-party borrowings of 300 crores. So, this AB Group has taken an external third party, say from a bank, the borrowing of 300 crores at interest rate of 12%. Further, AB Group's turnover for this year was 750 crores and EBITDA of 100 crores. Now we have seen when you apply this group ratio rule, then you have to compute that at the group level, what is your net interest to EBITDA ratio. So here we will have to calculate that, because the tax admissibility for Citicorp would be based on the group ratio. Now, tax rate applicable to all the three companies involved is 30%, and the country A has adopted group ratio rule. So here, group ratio rule is applicable. Therefore, you have to compute the ratio for the group. Let us see on the right-hand side how this calculation works. So in this case study, the group ratio will be calculated as you have 300 crore of the total borrowing from a group perspective. You are paying 12% interest on this 300 crores. Therefore, your total interest expense for the group is 36 crore. But your EBITDA is 100 crores. It is given here. EBITDA of the group is 100 crores. So the ratio group's ratio will work out to be interest expense of 36 crore, EBITDA of 100 crores, which means 36%. So 36% is this group's ratio. Now we have to use this ratio. Since country A has adopted the group ratio rule, interest deduction to this Citicorp in country A will be also kept at 36% of the EBITDA. Now what is the EBITDA here? EBITDA is 10 crores. So therefore, how much they will be entitled to? They will be entitled to by employing a higher rate of 36%. 36% on 10 crore. So what they are now entitled is 3.6 crore. In the previous case, everything remaining same, they were entitled to only 3 crores. Now, because of the leverage or the actual debt position in the group, now that interest deduction is increased from 3 crore to 3.6 crore. Therefore, this is the total. 3.6 crore is the maximum possible allowance which is allowed, which is possible. Now, actual interest expense is 6 crore. Now, assume if the actual interest expense is not 6 crore, but let's say only 2 crore, then of course, they will not be allowed 3.6 crore. They will be allowed only to the extent of the actual interest expense. But in this fact pattern, because the actual interest expense is 6 crore, the permissible limit based on the group ratio rule is 3.6 crore, and therefore the balance 2.4 crore is something which will be disallowed. And we have seen what happens to this disallowed amount. Can it be carried forward? It depends, depending upon what is the applicable rule, tax rules in this jurisdiction. So that's how the group ratio rule works out. Now we will look at another interesting thing, the interplay, which is the combined rule of how the fixed ratio rule and the group ratio rule is something which you need to work together if you have a scenario where both of them have to operate simultaneously. Let's see, this is the last case study for our deliberation today. Now, similar kind of a case study. Here you have three companies, ECO, BECO, SECO. They are the group companies engaged in various activities. BECO is a startup. BECO is a startup and is in a hotel industry. It's a startup and it is in a hotel industry. Whereas SECO just got revived from bankruptcy and is incurring high interest cost. So it is just got revived from the bankruptcy and incurring very high interest cost, relatively speaking, compared to the other entities. Now, country A, B, and C have adopted fixed ratio rule, and thus rate is 20, 30, and 50%. So country A, B, and C all are using FRR. The rates of FRR in the three countries as legislated by them is 20%, 30%, and 15%. However, this country C here, in country C, if you look at this point, country C has also applied GRR. So apart from FRR, apart from the fixed ratio rule, the group ratio rule applies also only in country C, right? The other two countries here, there is no GRR. If you see, there is no GRR which is applied. These two countries have only legislated the fixed ratio rule. Let's further read it here. And as per this, because of the GRR is being applied in country C, an interest deduction is limited to group ratio rate plus 10% uplift, which I gave the example in the previous case study, that if your group ratio happens to be 30%, then there will be a 3% of uplift if 10% uplift is given. Therefore, your group ratio would be reckoned as 33% after considering the 10% uplift. We will see this when we do the calculation. Now, country A and B do not apply a group ratio rule. Now, these are the financial information which is given to you for each of the three company and for the group. Now, group is kind of a sum total. Now, if you can see here, EBITDA for ECO and BECO is positive, ECO and SECO is positive, but BECO is incurring losses. It's a negative. So, total from a group perspective, the total EBITDA is 500, which is given by ECO and SECO and offset by losses from BECO. And the net interest to all of these net interest, the interest is to third parties. For each of them is 55, 45, and 100, aggregating to 200. As already mentioned, in this point also, the entire interest expense is to external third parties. Nothing is paid to group companies within the group. Also further assume that all the other regulatory compliances are met, and because of which otherwise interest inadmissibility is not something which is applicable. That means technically, but for the application of these two rules, this 200 is otherwise tax admissible interest expense. So basically what we have to look at purely how FRR and GRR will work, and therefore this case study requires you to compute interest expense that will be disallowed on the basis of the facts given here and these FRR and GRR. Okay, so let us see the solution in the next slide. So let us see how the interplay of the fixed ratio rule and group ratio rule works out. Now we have seen three companies from the group perspective: ECO, BECO, SECO, country A, B, C, and country A and B has only FRR, but country C has both FRR and GRR. These are the 20%, 30%, 15% is the rate for FRR, right? And GRR only applies to the CECO in country C. Now, what is the EBITDA? We have seen in the case study, it is already given. EBITDA of each of these entities is given 550, 500, and this guy is incurring losses. So net of 500. Now, what about the interest expense? Interest expense also has been given in the case study. How much is the amount? 55, 45, 100, aggregating to 200. So, from a group perspective, what is the net interest expense to EBITDA? If you calculate from each one of these cases, right, and even for the group, let us first look at from the group perspective. Now, group has incurred 200 of the interest expense on overall EBITDA of 500. Therefore, it gives 40% as the ratio. And for this entity, 10%. For this entity, 200%. We said, right, that, is a highly leveraged. So your EBITDA is only 50, but your interest expense is 100. Now, when it comes to this entity, because it's a loss making, this cannot be computed. So this will be kind of a not applicable. Now, move on to the competition. Fixed ratio rate in the country is something which we are already looked at here, is 20, 30, and 15. I just brought forward the data from this particular row. So therefore, if you apply the fixed ratio rule, how do you compute the allowable interest? Will be interest expense, which is allowed as per the fixed ratio rate of the rule in the country, will be a multiplication of EBITDA into this rate, right? So 3 into 6. If you multiply each of these cases, 3 into 6, you get the calculation, right? But of course, for country B, in country B, BCO, because there's a loss, it is 0. So 20% of 550 is 110 is your interest expense allowed as per FRR for ACO country A. In country C, it is 15% of 50, 7.5. Now, so this is as per FRR. Now look at whether GRR is applicable, and if yes, how much you can have the additional interest expense. Now in this case, we have seen ACO and BCO do not have GRR. So there is no GRR in this case. And therefore, in these two countries, there will be no interest allowable from the perspective of GRR. So only company or the country C where you can have potentially GRR. Now what is in this case? What interest will be allowed if GRR would have been applied for the CECO? What interest would have been deducted? We have seen 40% is your ratio, group ratio. 40% of the EBITDA of 50. So 40% of 50 EBITDA is 20. So if GRR is applied, CECO should get a interest tax deduction of 20. But then there is a 10% uplift. And therefore, this 20 will be replaced by 22 after considering 10% uplift. So 110% of otherwise what is allowable as per the GRR is post the uplift is the allowable interest deduction which you have if you apply the GRR. Now, so what is the maximum interest that will be allowed? See, actual interest we have already brought in. These actual interest is something which we have already recorded here in this row. So I have brought forward here for the sake of comparison. Your actual interest is this. But then what is the interest that can potentially be allowed? It will be higher of row 7 and row 10. What is that? See here. FRR says that for ACO, 110 is your interest deductibility maximum. GRR is 0. So higher of these two, 110 is the maximum limit which can be allowed as an interest deduction for ACO. What about BCO? Let us see this. BCO, this is 0. FRR is 0. And this one is also 0. And therefore, for this, nothing would be applicable no interest will be deductible for PICO. But when it comes to SICO, you have FRR based computation 7.5, group ratio after uplift is 22. Higher of these two numbers is 22. So therefore, the maximum permissible interest which can be for which the deduction is available to each of these entities is 110, 0 and 22, aggregating to 132. Now this you need to compare at each entity level against what is the actual interest expense they've incurred. They've incurred 55, 45, 100, aggregating to 200. Now, the lower, of course, the deduction cannot be more than what you have incurred. So in case of ACO, though the limit is 110, you have only incurred 55K or the 55 as the interest expense. So therefore, this will be allowed. What will be allowed is 55. But for BCO, nothing is allowed. 0 is allowed. Right? And for SICO, the 22 is the amount of interest which is permissible to be deducted. And therefore, what will not be disallowed? What will be disallowed? Your total minus what is allowed will give you this. So 55 minus 55, 0, nothing is disallowed. 45 minus 0, 45 is disallowed. And 100 minus 22, 78 is disallowed. So on an overall basis, though 200 worth of interest has been incurred at the total group level, what is allowed is only 77, is split between 55 of ACO and 22 of SICO, and the balance 123 is something which is disallowed, consisting of disallowance for BCO and SICO. Now, of course, what happens to this 123K? We have seen that for each entity, each country, you have to look at what is the tax law applicable for each of these countries, and accordingly, there will be a potential to carry forward and use it in future. So this is what I wanted to cover for this particular video. Now, this what we have seen is the action plan 4. Now what we will see in the next video, I will initiate another series of video where we will see what is India's response to action plan, how India reacted and did legislation in its domestic tax law to take care of the recommendations given by action plan 4 by OECD. The quick answer I am giving that India legislated section 94B of Income Tax Act 1961. So in the next series of videos, we will deep dive into section 94B of the Income Tax Act, how it operates in consonance with the requirements of the BEPS Action Plan 4. This is something is yet to be discussed. This we will discuss in the next series of videos. So this is what I wanted to cover for this particular video. As earlier mentioned, this is my YouTube link. This is my LinkedIn link. Please do subscribe to the channel and support the channel. Comment, share, whatever you can, whichever way you can help the channel. I will really appreciate that. But for this particular video, this is what I wanted to cover. Thank you. Bye for now.